Right, and Forex, folks, we're talking about is China's main challenge, that is containing inflation. Does it mean we're going to see further appreciation of the renminbi? That could be one outlet or tool they use to try and tame inflation. The PBOC, China's central bank, yesterday set its midpoint against the dollar near to a record high. And a lot of analysts say this week we could see a new post-revaluation high for the renminbi. Yes or no? Tiu-Chin Liu joins us, senior FX strategist BNP Paribas, along with Yu-Dee Chang, staying with us out of D.C., principal and chief advisor at ACE Investment Strategist there. And our guest host, Arjun Mahendran from HSBC Private Bank, is still with us around the desk here at the SGX. Chin Liu, great to see you. Happy holidays. We're on track. Last I sort of did a quick back of the napkin calculation for renminbi to have appreciated about 6% for this year, 2010. Are we going to see a post-reval high, or are we going to see a big pop sometime soon?
I think we're certainly leaning towards that way. I think the concerns for the Chinese policymakers right now is clearly inflation, and they're coming out in all ways to control that. So I think that has encompassed a stronger Chinese yuan as well. And the fixings, despite the dollar not moving too much against major currencies, against Asian currencies, but yet dollar China has been fixed repeatedly lower over the last 5-6 days. Means that they are employing a all-out attack to control inflation.
Wow.
So I think it's very likely we will see the Chinese yuan press towards a new high, even before the year is out.
Even before the year is out. Arjuna, agreed?
I think so, yes, because it clearly is a very important tool. And you can't raise interest rates anymore in China, at least not if you don't want big flows of capital to come in and wreck your, the whole bubble thing and controlling all this money going into property and Chinese bonds and the stock market. So I guess, raising the currency is one way of making imports cheaper. And remember, a lot of it being driven by food prices. A lot of which is imported now because China had its own share of agricultural setbacks because of weather. So I think, imported food prices would definitely be dampened. As the
all right. Yu-Dee, over in D.C., inflation is one thing, but Hu Jintao and his visit to Washington next month is another. How much of this is going to be politically motivated as well, do you think, if you do see a post-reval high for renminbi before the end of the year?
Yeah, I think this has always been a problem, a little bit tension between U.S. and China. I think part of the benefit of in Washington is that we get to talk to politicians and also government officials on both sides. I think basically this, U.S. saying that, well, China, you want a free trade with U.S., however, you're not going to allow your currency to float freely. So U.S. is saying that, you know what, unofficially, they actually want the renminbi to, you wouldn't believe this, appreciate about 30% or so. China is saying there's no way we could do that. The U.S. saying then we want to do it year by year. China is saying, you know what? Every year they set a target of somewhere right around 7%, maybe the lower end of about 4.5%, and the upper end about 8% or so, and doing it in about 5 years or so. That's why you saw an appreciation of about 7% this year. I think you will continue to see that. A lot of chatters. At the end of it, you'll probably see another 6 to 8% of appreciation of RMB against the dollar over 2011.
Well, it'd be hard to garner 30% appreciation when the Chinese economy needs to make those structural shifts. And of course, a lot of the industries there are very low margin businesses. But I'm just wondering, Chin Liu, in terms of the prospect, we're looking down the barrel of a stronger renminbi or yuan. What's that going to mean for the rest of the emerging market currencies? I would assume that we're going to see faster acceleration in that, and that's going to cause more problems for the policymakers out here.
Yeah, I think Asia is watching what China is doing on its currency front, but yet I think the inflation problem in China is probably a little bit more pressing than it could be for the rest of Asia, for example, in Thailand or Philippines, where inflation is not really running that much stronger. So I think it's going to be watching what they do, but clearly I think as well Asian currencies have appreciated far beyond Chinese currency in 2010, and therefore the Chinese yuan could do a lot more catch up in 2011. But having said that, I think the trend appreciation of Asian currencies is still very much intact, clearly as well, because commodity prices are rising, and one way to counteract that would be through stronger Asian currencies. And I think that's something which Asian central banks will be more comfortable employing, particularly if Chinese yuan strengthens alongside.
Here's the thing that could have backfired, because Adam raised a good point here. Some of the margins are already pretty thin at the lower end, and with manufacturers already facing higher input costs, higher wage costs as well. you go and have a big one-off revaluation of the renminbi, isn't that going to hurt even more?
Certainly, I think the latest upgrade in capital account that we saw in China, where it's upgraded in Q3 by a total of 10 billion, shows that capital inflows into China remains a pressing problem for, not just China, but the rest of Asia. So on the back of that, yes, whilst hiking interest rates would, sort of attract more capital inflows into the Asian region, on the back of that, I think central banks will continue to be very watchful of that, and capital controls will be a theme that will persist into 2011.
Okay, here's the thing, and how much of the pressure upwards on renminbi, we've had, I think, 5-6 consecutively higher fixings. How much of it is hot money anticipating ever tightening monetary policy in China? I mean, that's one of the, I guess, secondary consequences or effects of the rate hike just over the weekend, that it would attract more hot money inflows, no?
But also remember, Martin, that the Chinese now are allowing foreigners to hold renminbi in Hong Kong, and now in Singapore you can open a renminbi account, and this is attracting huge amounts of foreign capital into China. In any case, the so-called offshore renminbi market, where the exchange rate is different from the onshore renminbi exchange rate, but they've been converging in recent weeks, which I find fascinating. So to me, I mean, I don't think the Chinese are too worried about capital inflows, because remember, in the backdrop, what's going on is that US consumption is stepping up to the plate. Chinese exports are doing extremely well. So I think, the so-called lack of competitiveness issue when the renminbi appreciates is now probably being ameliorated to some extent.
Because demand is picking up.
Exactly. Japan's picking up, the US is picking up. Chinese exports haven't really been dented by a 7% appreciation this year. Remember, the renminbi has appreciated 20% against the US dollar since 2004. That's a pretty big move. And it hasn't really done, I think, any damage to the Chinese export sector so far.
Okay, here's what's counterintuitive, though. Demand is picking up. We had the holiday shopping season numbers out from there, probably at the best levels we've seen since, I think, 2005. Yet at the same time, unemployment is still stubbornly high. And Yu-Dee, a couple of minutes ago, was talking about how, thousands of jobs have been created by U.S. companies, but the bad news is overseas. If that's the case, who's doing the consuming then? That doesn't really make sense to me. Chin-Lu?
Well, I think demand in the U.S. is surprised on the upside. I think the resilience of consumers to spend whilst job employment prospects stabilize, shows that the spending appetite in America is still there as long as they think jobs are holding. So I think that shows that the world economy has not really shifted, and the U.S. consumer patterns, aren't going to change within a year, even with the big shock that it's had. So I think it goes to show that the world is still running along, is still chugging along, and prospects for growth, although they may moderate next year, it is coming from fairly high levels this year. And the surprise this year really has been that growth has been stronger in the U.S. than most anticipated.
Yu-Dee, I just want...
Martin.
Yeah, go ahead, Yu-Dee.
Actually, that's one of... that's one of the theme of next year, is this so-called new middle income level from the emerging countries, such as China, Brazil, Colombia. These people are the ones who's actually doing the consuming. That's why one of the reasons we actually like the so-called consumer discretion sector. I think this sector, this so-called new middle income level, is going to actually influence a lot of what's the spending, consumer spending going forward.
Okay, interesting idea. Yu-Dee, gotta go. Wish we had more time. Happy holiday, and see you soon next year. Yu-Dee Shang there from Ace Investment Strategist, live out of DC. Also, thank you, goodbye to Tien Lu, BNP Paribas. And we'll get back to our guest host, Arjuna Mahendran, HSBC Private Bank, for more coming up in just a bit. Right now, though, let's swing up.